Instructions to get subtitles in French and Spanish will follow shortly.
Comment ajouter des sous-titres dans votre langue? Étape 1. Cliquez sur l'icône CC en bas à droite de la vidéo pour activer les sous-titres. Étape 2. Cliquez sur l'icône des paramètres. Étape 3. Cliquez sur sous-titres CC 1. Étape 4. Cliquez sur Génération automatique. 5e étape. Sélectionnez votre langue. À ce stade, vous devriez commencer à voir des sous-titres dans la langue que vous avez sélectionnée.
Cómo añadir subtítulos en tu idioma. Paso 1. Haz clic en el icono CC en la parte inferior derecha del vídeo para activar los subtítulos. Paso 2. Haz clic en el icono de configuración. Paso 3. Haz clic en subtítulos /diagonal CC 1. Paso 4. Haga clic en autogenerar. Paso 5. Selecciona tu idioma. Selecciona tu idioma. En este punto deberías empezar a ver subtítulos en el idioma seleccionado.
I'll start with a question that is really important before we get into any other questions, which is about the basis of accounting. Is INPAG accrual basis? That wasn't quite clear from the video, so let's clear that one up first. Karen, can I give that one to you?
Sure, yeah, no, that's fine. Absolutely. That was we've divided the content over 4 different sessions, and the accrual basis is the fundamental concept that underpins INPAG. So I can confirm that it is the accrual basis that is the key principle on which all this guidance is being based. Hopefully that's a fairly short and sweet answer to that question, but just to confirm, it is the accrual basis.
Brilliant, thank you. Good to get that one sorted first. There's a question here about how it links to the UK guidance, the FRS 102, which is the basis for SORP. I know not everybody is here from the UK, or just a few, but would you mind taking that one? How it links to the guidance in the UK?
It doesn't directly link to the guidance in the UK. It's based on IFRS for SMEs. However, FRS 101 in the UK is also based on IFRS for SMEs. So in that respect, they are going to be very similar. And as well as looking at IFRS for SMEs as source material, in some cases, we are also looking at national standards, as well as IPSAS for where we think there are specific NPO issues that need to be addressed. So FRS 101 and indeed the Charities SORP, which is based on FRS 101, are being taken we are looking at those for guidance where there are specific NPO issues that are not fully addressed in IFRS for SMEs.
Brilliant, thank you. And as we stated earlier, it's up to each jurisdiction to actually apply INPAG. So whether it's adopted in the UK is a separate question from how linked it is. So that's good. There's a question here about comparatives. In that section about comparatives, and we talked about comparatives of different funds, the question is, what would those comparatives be to? And I guess, would it be last year? Would it be a budget? What are the comparatives about?
The general requirement in IFRS for SMEs and other accounting standards for the comparatives is that you would show the previous years. So, for example, in the statement of income and expenses, showing all of the comparative information, we would have income and expenses with restrictions, income and expenses without restrictions, and a total for both the current year and the previous year. Aware that IPSAS includes a requirement to show a comparison with budgets where those budgets have been published previously, either as a separate statement or as an extra column in the statement of income and expenses. INPAG is not requiring that. We're sticking with the basis of IFRS for SMEs as the accounting. We're not incorporating that budget requirement. But INPAG, like all accounting standards, sets the minimum requirement. So if an NPO thinks a comparison with the budget would be helpful for its readers of its financial statements, nothing to stop it actually including that information.
Great. And Karen, do you want to add on something there?
Yeah, I do. So another piece of work that we're doing as part of the project is looking at the possibility of some forms of supplementary statements. And we frequently get asked about project or program or specific grant information, and the ability to include that as part of general purpose financial reports. We are looking at that. We want to come up with something that is principles based, that works as part of general purpose financial reports, and our thinking and proposals for that will be included in exposure draft 3. The reason for mentioning that now is, of course, that one of the things that we might come up with for that is, if it's useful, a comparison to a budget, for example, or an original grant or program plan for something. So those are the kinds of possibilities that are being considered. And I should add that anything that we do in this space will not be part of a mandatory requirement as part of INPAG, but to generate some principles and guidelines that NPOs might choose to use if reporting that kind of information as part of general purpose financial reports would be useful.
Brilliant. And we'll be presenting that in ED3. So that's ongoing work that we haven't made public, but that will be coming out in November, hopefully later this year. Thank you. I've got a question here about donations of property, plant and equipment, which is something that's very special to this sector. It doesn't happen often outside the sector. The question is that it seems to infer from the video that it would be included in the statement of cash flows. But if it's actual donation in kind, where would that go? Just some clarity around where donations of gifts in kind of PPE would be shown.
There are two ways in which NPOs may be given PPE. In some cases, it will be a donation in kind of the asset, and that wouldn't show in the cash flow statement itself because, as the question says, that's not a cash transaction. However, the other way in which NPOs might receive assets is they may be given the funds to purchase the asset. So they may be given the funds to purchase a building or to purchase a car. That would be a cash donation. And we think it's important to separate those from other grants and donations in the cash flow statement for transparency. So in terms of the actual statement itself, it will just be those cash donations that are required to be used for the purchase of an asset rather than any gifts in kind. Brilliant.
Thanks for that, Paul. There's a few questions around restricted funds, so let's take some of those. We've heard there's an example of a situation where you couldn't spend the restricted funds during the time limited, and then you have to refund. So if you have unspent restricted funds that you have to give back and you're paying it back to the donor, where would that show up in the financial statements?
That will partly depend on how we recognise revenue, and that recognition of revenue is going to be included in ED2. So it may be jumping the gun a little bit to answer that now, but there are two possibilities. The first is that when the cash was received, the NPO recognised a liability, in which case, if you make the repayment, you would simply reverse those entries, reduce the liability and reduce the cash. If you've actually recognised the revenue in the statement of income and expenses, then the repayment of any amounts would be would require you to recognise an expense in the statement of income and expenses.
Great. So a bit pending ED2 there on revenue recognition, but that's a really pertinent question, and thank you for that, because that will feed into some of our thinking. A question that I've had in from some of our working groups is about the transfer between funds. And at the moment, that's sitting in the statement of changes in net assets. And I just wanted to ask, why did you decide to put it in that statement rather than in the statement of income and expenses? I know some NGOs use that line for an indirect cost charge, where they're basically taking it out of the grant fund and putting it into unrestricted funds as a one-line item. So it'd be great to hear your thinking on why the thinking for why it belongs in the income and expenditure statement.
Generally, those transfers will take place after a grant has been used for the purposes specified. So it will be used for to provide the grant, and then if there is any surplus that the NPO is allowed to account for, that will then be transferred to the sort of more the funds without restrictions, and generally those sort of transfers would be done in statement of changes in net assets, because they're not affecting the income and expenses. Really, it's simply how any surplus is being used. If the grant conditions allow you to charge indirect expenses to that grant, then actually we would expect to see those expenses showing as expenses under the restricted funds column rather than unrestricted. So that you'd expect to see them being charged against the grant directly in that restricted funds column in the statement of income and expenses. So that's why we've adopted that approach at the moment. But obviously, this is subject to consultation. If there are good reasons why we should change that, or think about circumstances when it might be better to show it elsewhere, then please tell us that in the responses to ED1.
Brilliant, thank you. Still linking to restricted funds, and this is a question from Wilfred in Kenya. A common thing is no cost extensions. We haven't managed to spend the funds in the period of the grant. You apply for a grant, a no cost extension. How would that show up in these financial statements, in the income statement? Could
you explain what no cost extension means, please?
You get more time to spend the same money. We're not going to give you more money, but we are going to give you more time to spend the money.
Right. Okay. In that case, again, partly, well, it probably won't show up in the financial statements particularly, because you will have recognised either revenue, which you will still remain in your fund balances, or you will have recognised a liability which will remain until you've used the funding. But what you would probably do is, in the note disclosures, add a note to say, we received this money, it was due to be spent by this date. We haven't spent all of the cash, but we have received an extension. So this money is now we now have until this revised date to spend this money. So for transparency, you would probably include that in a note to the accounts where you're explaining how the fund, well, what constitutes the fund balances.
Brilliant, thank you. So we've got a mixture, depending again on the revenue recognition and ED2, that might be something that we can clarify further. There's a question here about gains and losses, and there's quite a bit in the video about some fairly technical sounding gains and losses. Somebody said here, in my context, NPOs are not sophisticated to a level where they can measure losses and gains on investments, defined benefit schemes. It's all sounding a bit scary. Is it mandatory? So if an NPO adopts this standard, do they have to put all those things in the accounts?
A lot of them will not be relevant to many NPOs. But if you do have them, then yes, it is mandatory to do the gains and losses. Property, plant and equipment, for example, and also investment property, 2 models are allowed under IFRS for SMEs, and therefore under INPAG, because we're not looking at those sections at the moment. There is a cost model where no gains or losses will arise, and there is a revaluation model where gains and losses will arise. If you adopt the revaluation model, then yes, you'll have to account for those gains and losses. But if you adopt the cost model, then you won't. So that will be a choice for the NPO. In terms of gains and losses on financial instruments, if you're doing straightforward loans, borrowings with no complications, then there will be no gains or losses arising on those. But if you get into the more complex financial instruments, then yes, INPAG, in the same way as IFRS or SMEs, will require gains and losses to be recognised in different places. But if you're not, if it's unlikely that NPOs that aren't sophisticated enough to address the accounting will be handling those transactions, because you need very sophisticated systems to actually manage those loans and borrowings, or those financial instruments that have those complexities anyhow. So if your organization is sufficiently complex to have those transactions, it should be sufficiently capable of dealing with the accounting for them.
That's encouraging. So if it looks scary and technical, it might not be relevant and you don't need to worry about it. Karen, did you want to come in?
Yeah, no, I just kind of, I mean, in creating INPAG, we need to try and cover all of the types of transactions that an NPO might have. And so it covers the very simple to the much more complex because of that. The guidance is mandatory for all of those transactions, but as Paul and Sam were saying, the likelihood is that many NPOs are going to be having the more straightforward, simple transactions and will not have to even look at things related to gains and losses, because they just don't have those kinds of transactions. And if you don't have those transactions, then you don't have to do anything and you don't have to report them as part of your financial statements. It's there for those that do, and there may be some, but we're expecting most not to.
Super. So covering all the bases for a range of organisations. So I've got another question here, linked to gains and losses. Can you explain, in the video, some gains and losses are in the income and expenditure statement, and other gains and losses are in the statement of changes in net assets. Is there a fundamental difference between those types of gains and losses that dictates where they go?
It comes down to where the accounting standards require those transactions to be recognised, and because we're basing the accounting on IFRS for SMEs, it depends on where those gains and losses are required to go under IFRS for SMEs. If I take an example of property, investment property, if you use the revaluation model, IFRS for SMEs requires that to go through income and expenses. So that's where those gains and losses would appear under INPAG. They would appear under income and expenses. If it's property, plant and equipment, then any gains and losses on revaluation go through a revaluation reserve, so net assets. So under INPAG, those gains and losses are not shown in statement of income and expenses, but in the statement of net assets. Generally, IFRS and IFRS for SMEs use the income and expenses statement for fair value gains and losses that are more sort of related to investment. So investment property, financial instruments, fair value gains typically would go through income and expenses, whereas for other gains and losses such as property, plant and equipment, where it's they're not necessarily being held for investment purposes, more likely to go through statement of net assets. But it's not a hard and fast rule. Standards have developed over many years, and views as to when fair value gains should go through income and expenses or net assets do tend to have changed or not been consistent across that period. So partly it's a historical feature, but partly it's more investment related gains and losses are more likely to be through statement of income and expenses.
Okay, that's super. Oh, Karen, do you want to come in? Yeah.
Just to say, the guidance tells you where to go. You don't have to make a judgment about it. So you just need to follow what the guidance says. And I think as we've said with this piece of work, we haven't been able to look at all of the accounting topics. We've prioritized some, and that's why we've got some in both, because there's just some topics that we can't look at as part of this first edition of INPAG, and so as we get to those topics, we will look to update that and consider where do we think these things need to go in future.
Brilliant. We're out of time for questions. There are two more, which I will say very briefly will be covered in future exposure drafts. So there's a question about indirect costs and if that will be shown in the statement of financial performance. So the way we classify expenditures will be covered in future later this year. And there's one about Forex and foreign exchange effects of donor regulation. Again, yes, we will cover it, but it's not in this exposure draft. So I won't pass those questions along. So one here is about fund accounting, and it said in the video how the income statement and the statement of changes in net assets have separation between funds with restrictions and funds without. So why is it that INPAG requires a split between amounts with restrictions and amount without restrictions in the income and expenditure statement, but not assets and liabilities? What's the reasoning behind that one? Can you speak to that, Paul?
Yeah, the thinking behind that is it's an attempt to make the statements less onerous for NPOs to prepare. So in terms of looking at what donors have provided, they typically want to see a split between income and expenses linked to what's restricted and what isn't. But if you're looking at assets and liabilities, that might be more complex. For example, you may have purchased an asset which is used partially for restricted purposes, partially for unrestricted purposes, and then having to split that asset, particularly if you're doing something like revaluing that asset, would be difficult. So to keep things simple, we're concentrating on income and expenses separated between restricted and unrestricted, because that's what we've been told by donors and other stakeholders are the important figures, and not requiring that split in the statement of financial position in the balance sheet, because it's more complex, trickier, and it, from the feedback we've had so far, doesn't seem to be as important to stakeholders.
Great, so focusing the effort where it will add value. Super. There's a question here. Restricted funds are supposed to be recognized as income once received by the donor, or is there also room to recognize it as a liability and manage it as deferred income even as it's being expended? So we have an income recognition question for you, Paul.
Yeah, we'll be looking at the detail of how this income should be recognized, this revenue should be recognized, whether it should be treated as a liability, deferred, and then recognized as revenue as the activities are carried out, or whether it should be recognized immediately on receipt, or whether it's going to be different treatments depending on the circumstances. And we're going to be looking at that in the next exposure draft. So exposure draft 2, that will deal with the revenue recognition. So the text, the examples of the financial statements show where revenue would go, potentially where the liabilities would go, but we haven't got into any details about when you would recognize revenue immediately or when you would defer it as a liability until we've looked in more detail at the revenue treatment in the next exposure draft. And potentially there may be some changes to the format of the statements depending on decisions that are made and the feedback we get on that later exposure draft.
Great. So we've got the exposure draft split into 3 sections, and this ED1 is really the framing and the framework. So we're looking at the overall shape of the financial statements and how they will look, rather than exactly which numbers would go where and under what circumstances. So that's really helpful. Thank you. There is a question here from Gareth in the UK. Why have we gone for the term funds with and without restrictions rather than unrestricted and restricted, which are widely understood terms in the UK, and much easier to read the columns because they don't start with the same word? And I note that speakers in the meeting are even saying unrestricted and restricted because that's kind of what we're used to. So what was their thinking behind that slight change in terminology?
I think, and Karen will probably sort of contribute to this as well, in some jurisdictions, restricted and unrestricted have legal meaning, which may potentially be different to the way that we're using it in INPAG. So to try and avoid any conflict or any confusion, we're using different terms to avoid terms that in some jurisdictions have a particular legal meaning. Is that correct, Karen? That's my recollection.
Yeah, and I think there is also in IFRS for SMEs, they talk about restricted cash, and restricted cash has got a particular meaning that is not entirely consistent with what we mean by restricted. So it is a really difficult one in terms of terminology, because sometimes the terms that you'd like to use are already used for a different purpose elsewhere. And what we've tried to do with the work that we're doing here is where a term is already used, try to have the same meaning for that term in INPAG. So you haven't got different definitions across different types of international guidance. But we'd really love to hear from people in terms of thoughts about this. You know, we've done this in an attempt not to confuse, but actually if there is a viewpoint that actually it's more confusing, then we'll absolutely take that into account as we move forward from here. So, you know, we'd love that to be part of the feedback that you provide on the exposure draft.
Brilliant. And also I think we're quite aware to not be too UK centric. So it's very common, unrestricted and restricted in the UK and in countries that have had a lot of influence from the UK, but they're not particularly common in every country as well. So that's another reason for trying to rethink there. So that's a great question. There's another one here from Ram about the definition of restricted funds. Is that expected to include funds with restrictions placed by management, like a sort of internal restriction, or is it only funds that have an external restriction?
We're only looking to use funds with restrictions to cover those where that restriction is external. When you look, certainly in terms of the presentation split between funds with restrictions and funds without restrictions, that will be based on external, whether those restrictions are placed externally, because that's what the agreements will include. That will be what the NPO is bound by. There will be funds that are set aside, restricted, in other words, by management for their own reasons, and that's normal, perfectly proper. But in the same way that management can effectively restrict those funds, they can also choose to take that restriction away and use them more generally. So it doesn't have the same economic substance. It's restricted because management wants it to be, but management can change its mind on those in a way that they can't with externally restricted funds. Brilliant. When we come to the statement of changes in net assets, there is always going to be the option to show separate, to split the funds without restrictions into different columns if people choose to do that. So if management think it would be helpful to show funds that we're using generally and funds that we've set aside for specific purposes, then they could be shown as separate columns in that statement of changes in net assets. But it wouldn't be a fund with restriction in the way that INPAG is talking about it.
Thank you, Paul. That's really helpful. There's a question here from Afulu. Now, in the video, there's quite a bit about gains and losses. And one at the front of Afulu's mind is exchange gains and losses are to do with grants. So, you know, and in a company setting, you think about revaluing assets and liabilities that are held in foreign currencies. In our NPO setting, it's often about what the donor says is the rate that you're allowed to use versus what might be a ruling rate. So how do we determine foreign exchange gain or loss is his question.
Would you like me to pick that one?
Yeah, I'll leave that one to you, Karen.
So this is something that we're going to be looking at in more detail as part of Exposure Draft 2. There is a section in IFRS for SMEs that talks about how to deal with foreign currency translation. Sorry, I'm trying to get my words out. We are looking to, at least for the time being, adopt the same principles that are set out in that section. But what we're intending to do is to develop some additional application guidance that addresses some of the circumstances that you've described in your question, so that we clearly set out how such gains and losses should be presented or in the financial statements, and what that means for how gains and losses are shown. So there will be more information to come on this in terms of proposals, but they will come as part of Exposure Draft 2.
Super, thanks, Karen. And linked to that, there was a question from this morning. Why are some gains and losses shown in the statement of income and expenditure, and other gains and losses are shown in the statement of changes in net assets? What's the sort of thinking behind splitting it that way?
Yeah, this phase of the INPAG project, we're not looking at every section of IFRS for SMEs. So there are some sections that no NPO specific issues were identified, so we're not addressing those in this phase. We may come to them later, which means that we're following the treatment in INPAG that is set out in IFRS for SMEs accounting standard. And in some cases, that standard requires gains and losses to be recognised in income and expenses. Typically, that tends to be more investment type gains and losses. So investment property that's being held purely for investment purposes, or financial instruments being key examples. And other gains and losses are set out of IFRS for SMEs, requires them to be shown as part of other comprehensive income in IFRS for SMEs, which under the proposals in the INPAG will be shown in the statement of changes in net assets. And that would be things like revaluation gains and losses on property, plant and equipment. So buildings that are being held for operational use, but where an NPO has chosen to adopt the revaluation model. So in that case, the treatment under IFRS for SMEs is different. And because we're not looking at those sections in this phase of INPAG, we're just taking the treatment in IFRS for SMEs, which means potentially we've got gains and losses in two different places. Those gains and losses won't be relevant to all NPOs. If NPOs are following, using the cost model for property, then you won't have either the revaluation gains for property, plant and equipment, or the revaluation gains for investment property. So they may not be an issue for many NPOs.
Right, okay, so this might not affect a large number of NPOs, and I know some people have watched the video and said, oh, that all sounds very foreign and doesn't feel very NPO-ish. So if that is something that, yeah, doesn't look familiar, you're not going to need it. So that's quite good to know, isn't it? There's another couple of great questions here. So Ram, also in Australia, is there going to be guidance on how to split general overheads between restricted and unrestricted expenditure? That is a hot topic, Ram. Great question.
Do you want me to take that one? Yeah, I'll take that. This is another promise for us. It's absolutely on the work program for INPAG, and you'll see proposals for this as part of Exposure Draft 3. So when we are looking at the classification of expenses as part of the topics that are within the scope for Exposure Draft 3, we will be looking at that question about indirect costs and the allocation of those costs as part of our considerations on that topic. It comes up many times, and clearly, you know, in an approach that looks at separating funds with restrictions from funds without restrictions, understanding how overheads should be, that may be relevant to both, should be allocated, is going to be a really important part of those proposals. So those will be included in ED3.
Super, thank you. We've got our work cut out for us, hey.
Mm.
So a great question here from Jose Hernandez in Venezuela. Thank you for this. The terminology of income and expenses. Now, Jose isn't keen on those phrases, and he was keen to understand why you have chosen to stick with the term income and expenses. In the UK SORP, for example, that they've gone for incoming resources and expended resources. And Jose, this is a translation from the Spanish, I think, but he says he prefers sources and uses, which is a bit more similar to that in the UK terminology. So why have you stuck with income and expenses, which feels like it's coming from the for-profit sector for the NPO guidance that we're developing?
There's been some debate over the title for the statements. Statement of financial performance was one option, which is used in IFRS for SMEs, IFRS. That was felt to be placing, in the feedback we got from stakeholders, that was felt to be placing too much emphasis on the financial performance as being the key performance measure. So we were looking to move away from that. And a number of different alternatives were suggested by stakeholders when they were responding to the consultation paper. Statement of income and expenses was, I think, the most popular of those suggested. Statement of financial activities was another, which again reflects the UK position, but because the format of the statement that is proposed in INPAG is different to that under the Charities SORP in the UK, we didn't want to use the same term for different names. Income and expenses, again, if different terms are going to be more useful, so using incoming resources, outgoing resources, or whatever terms people think would be more helpful, we'd be very happy to receive feedback from that as part of the responses to the ED. If the terminology isn't felt to be the most useful, then yeah, please let us know, and we can consider that taking the exposure draft forward. Again, it may also be an issue where different terms work better in certain languages. Yeah, income and expenses is well known in it in the UK and in English, without necessarily having too strong a private sector focus. But that may not be the experience in other languages, so knowing that would be helpful.
Right, super, thank you, Paul. I think, are there any more questions? We've got some more opinions, which is always welcome, but I think for this, we're looking for questions. So if you have got any more, please pop them in the chat. I'm trying to think of other questions from this morning. Oh yes, there was a question from one of our working groups about the transfers between funds. Now that's part of the changes in statement of changes in net assets. There's a line for if you want to move money between unrestricted and restricted funds. So the question from that group was, why is it below the surplus line effectively in the statement of changes in net assets, rather than above the surplus line? And I know the one of the examples that was given is for overheads, when you're said charging a grant, an indirect cost lump sum, and you want to take it out of the restricted fund column and move those funds into unrestricted so that they can cover more general expenses. Now that would want to be above the surplus line, because otherwise the surplus is misleading. Mm-hmm. So yeah, could you explain why you've put it down below the surplus line effectively? Yeah, so the thinking is that when we're looking at transfers from funds with restrictions to funds without restrictions,
what you're probably looking at there is cases where grants have been given, the activities those grants have been given for have been completed, there is a surplus left, and the grant conditions allow you to then use that surplus for any other purpose. And at that point, those funds cease to have that restriction, and they're transferred from funds with restrictions to funds without restrictions. The thinking about those cases where you've got this indirect expenses is that actually that would be shown as an expense against the funds with restriction. And as Karen said, we'll be looking at the expenses in exposure draft 3. Now, I appreciate there may be some difficulties where it's being done as lump sums across multiple funds. And if there are specific examples where that happens, it would be helpful to have some feedback on that in the responses to the exposure draft, because that will then help us develop the treatment in exposure draft 3 and make sure that we are picking up those transfers at that point. What we're really looking for is in the income and expenses statement of income and expenses, we show the activity in the year, whereas in the statement of changes in net assets, we're showing the balances on the fund and what remains restricted or with restrictions and what is no longer with restrictions.
No, that's very helpful. Thank you. And as always, with all of these things, if you have an opinion that you want to share, that's absolutely brilliant, and we want to hear from you. So the last few minutes of this meeting, I'm going to go back to sharing my screen and explain the next steps and how you can share your voice. So we do hope that these questions that have come to mind will make you want to share your voice. It's actually been really interesting to hear your questions and the types of issues and ideas that it's brought up. Some of the other points in the chat we'll certainly also take away and feed into future development. Now, you're really welcome to share your thoughts on any aspect in the first exposure draft, but the project team has drafted specific questions for you that we're particularly keen to get feedback on. And these are in a document called the Invitation to Comment, which is available on the website. And you can share your opinions on this exposure draft until the 31st of March. So how do you do that? To submit a response, you go to the website, the link on the screen, ifrfornpo.org/have-your-say. And you can download a template and upload your response. You can also fill out this very short form to let us know that you intend to submit a response. This would be really helpful for us to know who is planning to submit, and so that we can support you in the right language, make sure you've got access to the right resources. So please do consider, even now, clicking on that link and just letting us know that you do plan to submit a response. You don't have to respond to every question. You can just let us know about the things that you feel strongly about. Now, looking ahead, the next 2 exposure drafts are planned to be released around the end of June and November 2023. Feedback will then be used to draft the final guidance, which we expect to issue in 2025, ready for adoption and use. You will receive a follow-up email with the slide decks and the links to the videos and all the links that you need to engage with the process going forward. So in my final minute, thank you very much for joining us on this journey to improve the quality, relevance and consistency of financial reporting in the sector. I know for some of you, it's very early in the morning or very late at night, and I do appreciate you joining us. Please share your voice, shape the future. Do stay in touch by visiting our website, following the project on social media and reading our newsletters. And I'd like to give a final word of thanks to Karen Sanderson and Paul Mason and Brian Menya, and to all of you for joining us today, as well as the many volunteers who've supported our translation work for this event. Thank you very, very much. See you tomorrow, maybe. Good night.
Thanks very much, everyone. Thank you.